So a sale-leaseback transaction is one where a company who owns their real estate will sell the property to somebody else and then become a tenant in the property by entering into a long-term lease for that asset. Private equity firms often like to use a sale-leaseback transaction as part of the capital stack for acquiring a business. Most private equity firms, through their lending relationships, can get capital equal to 2 to 3 times, maybe 4 times EBITDA through traditional debt sources, secured lending, revolving credit facility. But private equity firms have very expensive equity, and if there's an opportunity to reduce the check from the PE firm from 40% of the purchase price down to 20% of the purchase price, it is tremendously accretive in terms of the yield for the PE firm. Consequently, most private equity firms like doing a sale-leaseback transaction if they can find a reliable buyer to come to the table at the closing table with their capital. We have designed our whole process around being able to provide capital to businesses on the date that they anticipate and in the amount that's expected, so that there are no surprises. Our equity investors give us full discretion to put up the money as needed, and we have access to our own lines of bank financing that does not require getting approvals from the lenders. We learned a long time ago that if we had to go to our lenders and get approval for a transaction, we were unable to control the timeline and the delivery of our capital. A sale-leaseback transaction can make the difference between winning a transaction with the appropriate capital structure and losing it, and once won, can make the difference between getting the returns that allow the private equity firm to achieve their hurdle returns versus not. So the sale-leaseback transaction can be a very helpful tool in the private equity world, either to acquire a business or to improve the yield on businesses that they already own.